As you can imagine, shareholders and corporations often don't want to pay tax in a reorganization. So there is a provision in Section 368A that allows these reorganizations to be non-taxable if they meet the requirements. And 368A contains numerous reorganizations, and they are called Type A, Type B, Type C, etc. And they're called that because of the provision in which they're found in the code. So Type A is 368A1A, for example. B is 368A1B. And if one of those is satisfied, then the reorg is non-taxable. Generally, if there's boot property in the reorganization, you might recognize some gain, but it's generally non-taxable. So in this section, we're going to talk about the tax treatment in a non-taxable reorganization if it qualifies under 368A. And then later we're going to talk about how to qualify it under 368A. So this involves the continuity of interest or investment principle. And this says if a shareholder in an acquired corporation continues to hold an interest in the successor corporation after the reorganization, that shareholder will not be taxed. So all of these Section 368A reorgs are going to involve some transfer of equity. We're going to have equity in the new acquiring corporation. And when we talk about tax treatment, we need to talk about three different parties. So we have the target, the person who is acquired. All right, we have the acquiring corporation, and then we have the shareholders. And these are usually the shareholders of the target corporation we're talking about. And we need to go through and talk about the tax treatment for each of these parties. Okay, so first the target or transfer or corporation. This is the person being acquired. Tax treatment there is found in Section 361, and it says there will be no gain or loss recognized to a corporation if such corporation is a party to a reorganization and exchanges property in pursuance of a plan of reorganization solely for stock or securities in another corporation a party to the reorganization. If the other property received by the corporation, so if there is other property other than equity received by the corporation and the corporation distributes that money or property as part of the plan of reorganization, there's no gain recognized. So if the target receives equity plus other property, so cash or assets or whatever, and it distributes those cash or assets to its shareholders, the target does not recognize gain. Now, we're not talking about the shareholder, we're talking about the target. The target itself does not recognize gain. But if they hold those assets and don't distribute them, they're going to recognize gain to the extent of the fair market value of those assets. No loss is recognized if that provision applies, if A applies but for other property not distributed. And then the assumption of liabilities of the target will not trigger gain. So if the acquiring corporation assumes liabilities of the target, there will be no gain triggered by that assumption. And then no gain or loss is recognized by the target corporation when it distributes the stock and securities received in a tax-free organization to its shareholders or creditors as part of the reorganization plan. Distributions of boot property made pursuant to the reorganization plan require the recognition of gain but not loss. If property is distributed to a shareholder or creditor subject to a liability, the fair market value of the property is considered to be not less than the amount of the liability. Okay, now we're looking at the acquiring corporation. This is the parent who wants to acquire the target. The acquiring corporation recognizes no gain or loss when it receives money or other property in exchange for its stock or securities as part of a tax-free reorganization. The basis of any property received in that tax-free reorganization is its basis in the target corporation's hands, increased by any gain recognized by the target corporation. There will generally be no step up in basis because gain or loss is usually not recognized by the target. And then the holding period is going to include the target corporation's holding period for the acquired property. And if you think about it, this makes sense. If there's no gain or loss recognized, then the basis will be a transferred basis. And if there's no gain or loss recognized, the holding period will include the holding period of the target. And then finally, the shareholders. So these are the shareholders of the target corporation. There's no gain or loss recognized when stock or securities of the target are exchanged for stock or securities of the acquiring, or in another corporation that's a party to the reorg. Gain will be recognized to the extent of the lesser of the realized gain or the amount of money plus the fair market value of other boot property received. So if the shareholders of the target corporation simply exchange their shares for shareholders of the parent, that's a non-taxable thing. If, however, the shareholders of the target corporation receive stock of the parent and other assets, cash or other assets, they recognize gain to the extent of the lesser of the gain or the fair market value of the boot property received. The gain will be characterized as a dividend if the receipt of the property has the same effect as the receipt of a dividend. We've covered this before in section 356, and then 302 would treat it as a redemption. Those rules would apply to treat it as either a redemption or a dividend. If no gain or loss is recognized by the shareholders or security holders, the stock and securities received take a substituted basis from the stock and securities exchanged. So if there's no gain or loss, the target corporation shareholders take a basis in the parent stock that's equal to the basis they had in the target stock. If there's gain recognized, the substituted basis is increased by the amount of gain recognized and reduced by the amount of money plus the fair market value of any other boot property received. And that's a general tax rule too, so that shouldn't feel too odd to you. If we recognize gain, we get to increase our basis, and then we reduce our basis by the amount of money plus fair market value of other boot property received. So plus gain minus boot. The holding period for the stocks and securities that are non-recognition property is going to include the holding period for the stocks and securities that are surrendered. However, the holding period for stocks and securities that are boot property and any other boot property begins on the day following the transaction date. Okay, and these charts are in your book. This first one is an asset acquisition, and this next one is going to be a stock acquisition. And so on the left column, the tax feature, we're talking about how to treat different parties for tax purposes, right? The target, the acquiring, and then the shareholders. And then the middle column is how you treat these people if the acquisition is taxable, and the right column is how you treat people if it's not taxable. Okay, so remember, to be non-taxable, it has to meet one of the types in section 368A, which we haven't focused on yet, but it would be an A, B, C, D, E, F acquisition, a non-taxable reorganization, to be able to be in that non-taxable column. Okay, so first, an asset acquisition. The consideration used in an acquisition, if it is a taxable acquisition, usually we buy the assets for cash and debt. We may use some stock if we want to, but we don't have to. But in a non-taxable reorganization, remember that continuity of interest doctrine is going to require us to use some stock, quite a bit of stock. It says primarily stock and a limited amount of cash and debt of the acquiring corporation is how we buy those assets. The target corporation gain or loss in a taxable acquisition, all gains and losses are recognized. All right, but in a non-taxable reorganization, generally no gain or loss is recognized. Gain would be recognized on an asset transfer when the target corporation receives boot property and does not distribute it to its shareholders. And then gain is also recognized on the distribution of appreciated boot or retained property. The character of the gain or loss under a taxable acquisition is going to depend on the nature of each asset transferred or distributed. So if it's a capital asset, then it's going to be capital gain, and we're going to have to worry about 1231 and 1245 and 1250. In a non-taxable reorganization, the character of the gain or loss is going to depend on the nature of each asset transferred or distributed. Again, that's if we recognize gain or loss. The depreciation recapture, under 1245 or 1250, the depreciation would be recaptured in a taxable acquisition. And in a non-taxable reorganization, 1245 and 1250 depreciation is not recaptured unless there's boot that would trigger the recognition of gain. All right, going on to the acquiring corporation. So this is the person who is acquiring the target. Gain or loss when the stock is exchanged for property. All right, in a taxable acquisition and in a non-taxable reorganization, there would be no gain there. They don't recognize gain when they use their stock to buy something, which is what's happening there. 3B, gain or loss when boot is exchanged for property. Under a taxable acquisition, the gain or loss would be recognized if non-cash boot property is transferred to the target corporation. And in a non-taxable reorg, gain or loss is recognized if non-cash boot property is transferred to the target corporation, right? So it's the same. The basis of the acquired assets in a taxable acquisition is the cost basis. But in a non-taxable reorg, the basis is going to be the same as the target corporation's basis, increased by any gain recognized. So that's the disadvantage, right, of a non-taxable reorg, is that if the target's basis is low, the parent's basis is also low, meaning when they sell those assets, the gain is big. 3D, the holding period of the acquired assets is going to begin the day after the transaction date in a taxable acquisition, but in a non-taxable reorg, it's going to include the holding period of the target. And then 3E, acquisition of target corporation tax attributes. So remember when we talk about tax attributes, we talk about earnings and profits, net operating loss, carryovers, things like that. In a taxable acquisition, those go away. We don't get to keep those. But in a non-taxable reorg, those do stay with the target. Okay, and then finally, the target corporation shareholders. So these, remember, the parent is acquiring the target, and the target has shareholders, and we are talking about those shareholders. So 4A, the shareholders, the amount of gain or loss they recognize. In a taxable acquisition, the realized gain or loss is recognized, and they're allowed to use the installment method if the payments are deferred. But in a non-taxable reorganization, the realized gain is only recognized to the extent of boot received, and realized losses are not recognized. The character of that gain or loss in a taxable acquisition is capital gain or loss, and it may be Section 1244 small business stock. In a non-taxable reorg, it could be capital gain or it could be dividend income if boot is received. 4C, the basis of stock and securities received. In a taxable acquisition, if the target corporation shareholders receive stock and securities, they receive a cost basis in those, which is usually the fair market value. In a non-taxable reorg, they get to substitute the basis they had in the target stock for the parent stock that they now own. It's a substituted basis. It's reference to the stock and securities surrendered. And then if they receive boot property, they take a fair market value basis in that property. 4D, the holding period of stock and securities received in a taxable acquisition is going to begin the day after the transaction date. And in a non-taxable reorg is going to include the holding period for the stock and securities surrendered the day after the transaction date for boot property. Okay, now finally in a stock acquisition, taxable and non-taxable treatment. Okay, so first the consideration used in the acquisition. If I'm buying the stock in a taxable acquisition, I usually buy it with cash and debt instruments. I might include some stock if I want to, but I don't have to. For a non-taxable reorg, the continuity of interest doctrine is going to require solely voting stock of the acquiring corporation or its parent generally to be a non-taxable reorg. And the target corporation, in a taxable acquisition, if I buy all the stock, right, there's going to be a parent-sub relationship established. And if the reorg is non-taxable, there's still going to be a parent-sub relationship established because the parent is going to own all the stock of the target. So the target is going to be a subsidiary of the parent. I am allowed under both to file consolidated tax returns because, again, the target is going to be almost 100% owned by the parent. The basis in the assets, 2C. In a taxable acquisition, if I buy the stock of the target, the basis in the assets held by the target is unchanged by this acquisition unless I make a 338 election. And in a non-taxable reorg, the basis of the target's assets are unchanged by the acquisition, and I am not allowed to make a 338 election. The tax attributes in both a taxable and a non-taxable acquisition or reorganization are still retained by the target corporation. And then 3, the tax treatment for the acquiring corporation. If the acquiring corporation buys all the stock of the target, they take a cost basis in that stock. If the acquiring corporation acquires all of the equity in the target in a non-taxable reorganization, there's a carryover basis from the target corporation shareholders. And then 4, the target corporation shareholders tax treatment. So A, the amount of gain or loss recognized. In a taxable acquisition, all of the realized gain or loss is recognized. And in a non-taxable reorg, though, if no boot is received, no gain is going to be recognized. And for D, the character of that gain or loss. In a taxable acquisition, it's usually capital gain or loss, but if it's Section 1244 stock, remember we can treat up to $50,000 of that as ordinary loss, or up to $100,000 if we're married filing jointly as ordinary loss. And in a non-taxable reorg, there's no gain or loss recognized, and therefore there's no character of that gain or loss.